fair criticism that the economics profession was somewhat blind to what unfolded in this episode. It is as if they were physicians and they had a diagnostic manual based on what you might call scientific theories that didn't describe the human body. In this case, it was the social body, the economic body, that was not being accurately understood, seen, and the implications for policy and guidance for society deriving from the wrong theory gave you the wrong prescription.
I think the economic profession bears a fair amount of responsibility for this crisis. Obviously, they didn't cause it directly, but if you think about the people who did cause it directly, financiers who took excessive risks, policymakers who failed to regulate the markets adequately, they themselves were responding to a set of economic theories which at the time appeared to justify and vindicate the behaviors in which they were engaging. Bankers may be greedy, but they're not stupid. And if they were taking excessive risks, if they were leveraging their portfolios 50 times, 60 times, it was because they were operating on the basis of theories, many of them developed by, as we know, Nobel Prize-winning economists, which suggested that those risks were reasonable under the circumstances. Regulators were allowing financial markets to have an excessive amount of freedom, again because they believed in theories which had come to dominate the profession, which suggested that financial markets were highly efficient and were more likely to take a measured assessment of risk than policymakers. So both the behavior of the financiers and of the policymakers, and indeed even of the borrowers who borrowed excessively, were ultimately based on economic theory. And I think that the profession has a great deal of culpability.
I do think that the economics profession bears some responsibility for this disaster. In the last 30, 40 years or so ago, the profession got increasingly dominated by what I might call the new classical paradigm. That is, the paradigm which essentially said markets are completely efficient, that intervention in markets is unnecessary of any kind, that the right policy, particularly in financial markets, is to allow the free play of market forces, and that will produce the optimal outcome. And there was a whole schools of economics broadly, macroeconomics and in financial economics, that put forward those views. Now, that was not how most economists looked at these things 50 or 60 years ago, because they had still the relatively recent experience of the Great Depression. All that experience disappeared, and as a result, the message that was coming from the most influential economics and economic schools in the world was, I think, this relatively simplified one. It encouraged and supported the already self-interested pursuit of the financial sector to become less regulated. It undermined the legitimacy of the belief that we should be looking at the incentives in the system, that we should be looking at the likely behavior in the system. And cumulatively and slowly, it eroded the defenses that we had created socially in the aftermath of the Great Depression. So it's clear to me, it's not the only responsibility by any means, but it is clear to me in retrospect, and I was not aware of this at the time, that economists do bear some of the responsibility for what's happened.
I thought what we saw really after the fall of the Berlin Wall was politicians and people in the financial services industry picking up a particular simple version of economics because it suited what they wanted to hear and what they wanted to say. And it was really what I came to call the American business model. It was a story about encouraging people to be very greedy and imposing as few constraints as possible on what they did. And the truth is, that wasn't a good explanation even of how the American economy really functioned, far less of how the rest of the world ought to be operated. But people pursued that particular story in a way which was bound to end in fiascos like, the collapse of Lehman.
I think the economics profession bears a lot of responsibility for the economic crisis. I do feel we really messed up on this badly. It's just remarkable when you think about the number of economists out there in the world whose job it is to focus on global financial stability. There must be well over 20,000 people in the IMF, in the Bank for International Settlements, in the Financial Stability Forum, in university departments, in central banks, in finance ministries. This is a huge collective group of economists, and they're the elite. These people have PhDs from great universities. These are not the normal international civil servants sort of selected through nationality pools or anything else. This is an elite of the global civil service, and these people were blindsided.
I think the principal responsibility of the recent calamity rests with bankers, and we should never forget that for one single moment. Now, there are a lot of people who are, as it were, bit players in the things that went wrong, and economists were among them. But the truth is, I think the economists were kind of dupes. You know, people in the financial services industry picked the theories they liked from the ones economists offered them, and they offered money conferences. It wasn't corrupt, but it was a corrupting influence of being applauded by people with lots of resources. Everyone ought to be angry. We've spent unbelievable amounts, trillions of dollars, bailing out people in the financial services sector, ridiculously overpaid people who thought they understood a lot more about the world than they actually did. And they're still there because we bailed them out.
Post-crisis, the failure of the profession has been to be unable to understand that economic theory has to accord with political realities and make recommendations in that context.
The institutional structure had major shortcomings, but so did the professional, so did the theory. And it partly informed the complacency. So if you read about what people said about the great moderation, that one could have these asset bubbles. If you read Greenspan, you read the Fed and the different institutions, they engendered complacency by saying that this could be managed, it could be unwound gradually. There was an absolute collective and institutional failure. And I think we really need to use this, as INET is doing, as an opportunity to think, wow, how did we get it so wrong? And how can we make sure that this doesn't happen again?
So what is actually rather depressing about this saga is that how much of what in some obvious sense we did know, both from experience and indeed from theory, from the work of theorists who got Nobel Prizes for it, how much of that knowledge was essentially ignored, dropped out of the discussion and replaced by this very simple, very naive free market paradigm. So that is the tragedy, in the sense it's not that we didn't know, there are lots of things we don't know, but even the things we did know, we suppressed.
My sense is that we're still in a Band-Aid environment. On the emergency rescue, it was necessary to pump a lot of money into the system. It's been vital. The patients come sort of on life support. That life support has worked. The problem now is, do we just go back to thinking we're healthy and fit again, as seems to be happening, or do we recognize that actually the underlying symptoms should have been recognized and we need radical changes, otherwise it's going to happen again?